Welcome everyone to today's webinar. This is Kent Jackway from Gordon Marketing. I'm the Director of Annuities, and we're going to spend some time today talking about what I call the Super Annuity. And this is going to be a product that we can use in a few different ways. It actually will solve some issues when you're working with clients, especially when it comes to suitability and access to money. So what we're going to do is we're going to spend a little time walking through the product, how it works, talk about some sales ideas, and excuse me, in the meantime, if you do have questions throughout the webinar, please type them in the question section, and even if it's while we're halfway through or whatever, go ahead and type them out, and I'll try to pause and answer questions as we go. I really want you to grasp this information because I think, honestly, this is a product that you could whip out and use with any client because there's so many good sales opportunities for it. So we'll go ahead and get started. And the product is actually from National Western Life. It is called the Lifetime Returns Select is the name of the product. Some basics on it. It's simplified issue, single premium, indexed, universal life. Yes, I did say universal life. I am calling this the Super Annuity, but it actually is a simplified issue single premium indexed UL. So how are we going to correlate this into an annuity type of presentation? Well, it all kind of comes back to perception. If we look at this product through the lenses of life insurance, we see a product that has easy underwriting. It's single premium. It has 3 really good index accounts. It has a return of premium feature, has tax-deferred growth, chronic illness rider in most states, and it has a tax-free death benefit. So on the surface, it looks just like a life insurance policy. But what if we look at it through the lenses of an annuity? We see a single premium annuity. We see 3 incredible crediting methods, and we also see that it has return of premium. Now, find me another annuity that has those features. And then find me an annuity that has a tax-free death benefit with a bonus. What's the bonus? Well, it's still life insurance. You're going to drop a big lump sum of cash into the product, and it's going to purchase a death benefit that's going to be a lot higher than what your premium was. So that's how we look at that kind of as a bonus. And then it also, in some states, has a chronic illness rider. So if I were to look at that through the lenses of an annuity, oh my goodness, find me an annuity that allows you to do those types of things. It doesn't exist. But still, when you look at it from a tax standpoint and just a saving standpoint, it works just like an annuity. But wait a minute. Hold on. There we go. If I pay a life insurance policy with a single premium, won't that be a MEC? Well, the answer to that is yes, it will be a MEC. But that's okay. Because let's go through and walk through what a MEC really is. A MEC is a life insurance policy that you've put too much money into. So if we have a life insurance policy that has $1 million death benefit, there's going to be a point where if you put too much cash in that breaks the 7-year TAMRA test, it will become a modified endowment contract. So any dollars that you put in up to that point, as long as you stay underneath that line, it remains life insurance. But as soon as you put more dollars in, it becomes a modified endowment contract or a MEC. So what is the 7-year TAMRA test? TAMRA stands for the Technical and Miscellaneous Revenue Act of 1988. What it basically says, in kind of a summary, is aggregate premiums paid at any time during the first 7 years of the contract, if they exceed the annual net level premium that's built into the contract on a 7-pay policy multiplied by the number of years the policy's been enforced, then you have a MEC. So in layman's terms, you can't put too much money into a life insurance policy because it'll change the tax treatment. So how does the Internal Revenue Service view a MEC? Well, they view it just like an annuity. You now change the taxable components of the product. So let's take a look at how that really works. If we have life insurance, okay, life insurance is FIFO, or first in, first out, is what FIFO stands for. So if you take a policy, the first dollars in the policy are the premium dollars, the money that the client put in. After that, you have the gains. So FIFO says you can take out your premiums first, then you take out the gain. So the first dollar in is the first dollar that comes out. So what do you get with FIFO? You get tax-free growth, tax-free distributions, and tax-free death benefit. As long as that policy is in force and it's not a MEC, it stays life insurance, everything is tax-free. On the other side, you have the modified endowment contract. Now that is LIFO, or last in, first out. So when you MEC a life insurance policy, you're literally just changing it from FIFO to LIFO. So how that works is you have the policy, the first dollars into the premium, next dollars into the gain. The gains have to come out first. Then the premiums can come out if you're taking distributions. So what does that mean? On a MEC, you now have tax-deferred growth, taxable distributions, but still you have the tax-free death benefit. So that's the biggest misunderstanding of a MEC. A lot of people misunderstand and think that the death benefit now is taxable. That's not the case. Just the distribution. So if you have taxable growth or tax-deferred growth, taxable distributions, what is that? It's just like an annuity. That's why we're calling this the super annuity, because it picks up the tax-free death benefits and you get all those other features. So if you had $100,000 and you wanted to put it into either an annuity or this product, both are going to grow the money, but it's just going to be a little bit different when it comes to death and when it comes to having access. So it's just more accessible and you get the tax-free death benefit. So some features about the product. The minimum face amount is $25,000. The issue ages are 45 to 85. You have 4 interest options. You have monthly average index, monthly point-to-point, an annual point-to-point, and a fixed rate. And I showed you what the rates were before. The caps are super high. The participation is super high. So this thing is going to grow money. Now, the one thing I will say about that is it will take a little more time because you do have the cost of the life insurance. So this is more of a long-term type of product. You also have variable loan options. You have a variable interest rate based on the Moody's corporate bond yield. The loan portion may earn interest if the crediting is higher than the loan rate. So in other words, if the crediting methods from the indexes return a higher rate than the loan rate, then any loan portion you take out is now still earning interest. Surrender charges. Issue ages 40 to 70, you're going to have a 14-year surrender charge. 71 to 80, it drops it to 12, and 81 to 85, it drops it to 11. You also have partial surrenders, 10% of the account balance. Funny how this thing, looks a lot like an annuity, even though it's life insurance. And that's going to be minus any loans and loan interest, and it can only be taken after the first year. Has a return of premium rider. You get the greater of the account balance or the minimum guaranteed balance minus the surrender charges, loans, and loan interest, or you get the premium value minus surrenders, loans, and loan interest. So basically, at any point, you can pull out the greater of those two things. Again, there's some annuities out there that have that feature. They're very few and far between. You also pick up some living benefits with this product. So you get an advance of the death benefit for terminally ill, the lesser of $250,000 or 75% of the death benefit, minus any loans or unpaid loan interest. You have optional accelerated riders, advance of the face for qualified care services, 24% annually, and it's paid out monthly up to $500,000. So again, find me an annuity that has those type of features. It doesn't exist. You also have a paid-up life insurance rider. They'll prevent lapse if the loan balance exceeds the account balance. There's no additional COI charge and charge made at the time of election. The underwriting. Now, this is the key, because a lot of times when I talk about this product, especially live, when I got people that are firing questions at me, they're like, okay, can I see this? I see how this can be used as an annuity. You know, it's single premium, it acts and feels just like an annuity, and you get some benefits, but my clients have to get underwritten for this product. And the answer is yes, they do. But at National Western, they still utilize the phone call underwriting process. So what you're going to do is you're going to ask your client some knockout questions, and we provide those for you. National Western actually puts it on their paper. You ask your clients the questions, and you'll know right then or there if they're going to get approved. If they answer yes to any of the questions, then they're knocked out. Don't even proceed. Go back to the traditional annuity route. But if they can answer no to all the knockout questions, then go ahead and proceed. So the next step is you're going to get them on the phone with the actual underwriters at National Western. Excuse me. So they're going to basically ask the same questions you just asked them, and boom, they're approved. So you get out the paperwork, fill it out, get the check, send it in, and your commission is paid in about 2 weeks. They are very, very efficient. So you don't have to fear the underwriting process with this product. It's not a case where you're going to send in an app, they're going to go get medical records, they're going to order a paramed and get blood and urine and all that. No, that is not the case with this product. It's a simplified issue, really, really simple. Let's take a look at what those knockout questions look like. So it's your typical simplified issue questions. You know, have you been diagnosed for AIDS? Do you have any impairments, physical or mental? Do you use medical appliances such as oxygen, respirator, dialysis machine? Have you had any organ transplant? I mean, we're talking about the catastrophic type of situations. Are you currently hospitalized or confined to a bed? You know, so this is one of those things where if you have some people that are just taking blood pressure meds or something like that, they're gonna be approved. Okay, the one that usually trips me up, actually when I was selling, I sold this product a lot, was I had a couple clients that went to their bank or went to their credit union and tried to get traditional life insurance, and they got declined. That's the one that I wish they would change, because, you know, if you take a company that has really strict underwriting requirements and they decline a person, it goes out on their MIB, that's going to screw you up for this product. So you need to make sure they haven't applied for insurance and been actually declined, okay, not just told they won't get it, they formally were declined. That's going to knock them out. So those are the knockout questions, and like I said, I blew them up for the screen. They're all on one page, and we can send them out to you. And you just have them in your bag and walk your clients through. And again, if there's all no's, then they'll get approved. Pay real close attention when you're doing the questions to, like, look at number 11 there. It says within the past 5 years. Okay, make sure the clients understand that when you're asking them. You know, and the next one on 12, in the past 3 years. You know, really read through the questions and be really familiar with them. So it's really, really simple underwriting. Approvals are pretty much instant, and you know, it's a great process. It's, you know, makes it almost as easy as doing an annuity. I mean, with an annuity, you got to go through the suitability questions. You know, with this, it's just real simple underwriting questions. Commissions. 10%. When you think about that from an annuity point of view, looks real attractive. So they're paying you really well to sell this product. There are chargebacks in years 1 through 3. So when you're out, and you're looking for the situations for these clients, make sure it's not something they're going to put the money in and take it right out, or you're going to have to deal with chargebacks. Now, if they're going to put some in and take a little bit out, okay, that's fine. But if you think they're going to fully surrender that thing, especially in the first year, you might want to think differently or really go back through and talk to your clients about other avenues besides this. Again, this is a product that's designed for really good growth for a long period of time. All right, let's look at a couple sales ideas, all right, where I think this product can really fit almost everybody you talk to. The first one I'm going to call the suitability savior. Here's Bill. Bill is very risk averse and wants his money safe. Doesn't want to have anything to do with the markets, variable annuities, anything like that. He wants safety. We've all met this guy before, okay? He comes to you asking for an annuity, and he has $400,000 of total assets. He wants all of it to be safe. Well, the only problem with that is, based on the suitability and annuity transactions model regulations that were passed in 2010, they're not going to let him put all of his money into an annuity. Kind of rule of thumb, they're going to let him put about 70% into an annuity. So what about the other 30% there? Well, Bill's got $400,000. That 30% represents $120,000. Definitely something you don't want to walk away from, especially if you're not securities licensed and you have nowhere else to take it. Well, now you do. This single premium life insurance policy will not count as an annuity, and it has the ROP, so it's completely liquid. That's going to look really good on a suitability form. So now you have an quote-unquote annuity option for the rest of their money. But let me throw a caveat out there right now. You got to understand that qualified dollars cannot be put into life insurance. So what you would want to do is when you're working with a client and they have both qualified and non-qualified dollars, you're going to put the qualified in the annuity, save the non-qualified dollars for the life insurance. So is it worth pulling this out of your pocket? Well, at that 10% commission, that's $12 grand, guys, versus sending them to the bank to buy a CD or having the money stay in savings or sending them to the investment guy that you work with. We can give the clients what they need, and there's a lot of bills out there. There's a lot of people that just want safety, and they love the indexed annuity concept. And now we can offer them something that's just like an annuity, basically is an annuity, but they get all these nice additional benefits along with it. So that's sales idea number one. Let's look at number two. I call it a better bank. You just completed a financial plan for Tim and Sue. They are very happy with the income planning you did. And in your data gathering, you discovered they have $25,000 in savings as cash reserves for emergencies. I ran about 62 appointments last year, and this came up all the time. When seniors get up to the retirement time, it's very prudent to have money that you can access, that you can just go get whenever you want. So the unfortunate thing is a savings account is pretty much the number one place where that money gets put. And I just think there's a better way to do it utilizing this product. So let's look at their bank. They've got this 25 grand sitting in their savings account. What does their bank look like? Well, they're probably making 0.5% or less in interest, and that is all taxable interest. The money is completely liquid, which is why they have it in there, in case they do have the emergencies. And the funds are safe. They're safe as a bank can make them. So that's the draw. Plus, if they do pass away, the money just goes right to their family. Whatever the balance is, goes. So that's their bank. Now let's look at your bank, the bank that you're going to suggest to these guys. In your bank, they could get anywhere from 2 to 6% in tax-deferred interest. So it's not taxable. They don't have to pay tax on what they make each year. They can defer it and let it compound. And they're going to have a much better chance of making money at your bank because they're not stuck to these super low savings account rates. In your bank, we're tying it to index accounts that have very, very good caps and participation rates, and they have a chance to make some real money. I mean, think about it. If they never have the cash reserve need, they never have the catastrophe, they never, even if it takes 10 or 15 years for something to happen to where they need to get their hands on this money, I would much rather be 10 or 15 years out in your bank versus their bank. There's going to be a lot more money in there. At your bank, it's also completely liquid because of the ROP. And the funds are safe. Okay, if you want to get into the discussion about what's safer, banks or insurance companies, honestly, we'll win every time because banks have gone under. Okay, insurance companies, if they do have issues, they get bought by other insurance companies. And we've never had a run on the insurance companies. So they are just as safe, if not safer. And a big difference is the death benefit. So if you have the money sitting in your bank and something happens and you pass away, boom, they're going to add some bonus to it and pay it out tax-free to the family. So a much better option at your bank. Let's look at some numbers. At their bank, 5 years, no emergency happens, they make about $631. In your bank, they're making about $2,600, and that's at the low end, the 2%. After 30 years, look at the difference. Almost a $10,000 difference. Just because you showed them a different place to put their emergency funds. Now that's at the low end. Look at the numbers. Oh, and sorry, taxes are not considered in that example. I wanted to, at least show some kind of a return. But look what happens if we get to the high end. If the indexes do really, really, really well. It's just huge, guys. In my opinion, anybody that has significant dollars in a savings account, if they're even somewhat healthy, they're crazy for not using this product. I mean, imagine you start retirement out and you live out 20 years of your retirement and you never had any big issue happen. Would you rather have $26,000 or would you rather have $44,000? I mean, just having the chance to earn that kind of money on the money that you're just sitting there for emergencies is amazing. I mean, this concept literally sells itself. So again, their bank versus your bank. Now, you might look at it and say, what do I want to waste my time going after, the $15,000, $20,000, $25,000 people having savings accounts? Well, don't forget the commission. I mean, $2,500 is worth going and seeing a client again, don't you think? I mean, that's kind of nice, especially if you're going back to your existing clients that have money sitting in savings, and you can offer them this concept. That's a nice payday to help these people out. So let's recap. The Super Annuity. It's actually life insurance. It's a great answer for suitability. It's great for cash reserves. Simplified underwriting. Pays you really nice. And it's like an annuity with a tax-free death benefit. In some states, or actually most states, you can get some long-term care benefits as well. And it has return of premium. So, that's pretty much the presentation on the Super Annuity. I just really, guys, I want you to get a grasp of this product. and I want you to understand that it is really easy to sell. It's really easy to explain. It's something that you don't have to overcomplicate. I think those two sales ideas are right where it fits. Do clients need a cash reserve account? Yes. Do most of them have it? So I would say about 50% will have a significant amount in savings. And the other side of it is when you run across those clients that want to have more of their money safe than what the regs will allow in annuities, it's a great additional option. So let's open it up for questions. If you have any questions now, go ahead and type them out in the question section, and I'll do my best to answer them. Okay, the first question here is, okay, how soon can you borrow from it if they have an emergency? The loans can start in year 2. Any other questions? I'm just waiting here for a second. Okay, here we got another one. If the clients, I'm trying to understand how this one's worded. Okay, basically, I see where you're going. With the underwriting process, okay, the clients, they have to be able to simply answer no to those questions. Okay, they're not going to go after medical records. And I think I see what you're saying now. Will they further underwrite it if there is a no question? The answer to that is yes. If they do get knocked out, you can submit and have underwriters look at it and make a consideration. And I noticed that one of you hit the raise your hand feature. If you can, just type the question out, and I'll do my best to answer it. Okay, I got another one here. How do the charges in the life insurance stack up to other single premium policies? The cost of insurance is actually pretty low. That's one of the reasons that they raised the caps and the pars so high, is to offset for that cost. So the growth, when you look at it from an illustration point of view, honestly doesn't look that great because, remember, because of those regs, the illustrations on IULs, they have to kind of drop down their rates of return to be compliant. But when I look at the actual performance of the accounts inside of this product, you're going to see growth rates in the first 10 to 15 years that will mirror a good index annuity. But then after that time period, it is where it absolutely goes crazy because the fees stop and then it's just pure growth. Any other questions? Yes, we do have brochures available that I can send out, and we also can quote this product right here in-house. So if you have some clients that you're thinking of and you want to see what it looks like, send it in. Because I will tell you on the quotes, the age makes a huge difference, particularly with the death benefit. So if you've got an older person, their death benefit might not be as favorable as a younger person. But that doesn't mean you don't sell it to the older people because, again, you're selling this like an annuity, not like life insurance. That death benefit is just an extra option. It's, kind of a perk, if you will. You're selling it for those growth accounts inside of there, and you're selling it to give them more access to the money than a typical annuity because of the ROP. Great questions, guys. Any others? We'll give it just another minute here. Okay, looks like maybe we're done with the questions. Well, listen, guys, thank you so much for spending some time with me this afternoon. Hopefully you learned something. I think this is a product, again, that you kind of keep in your back pocket. I mean, always ask people, what are they doing for cash reserves? Their emergency accounts. This is a great alternative for that. Or when you're doing your planning for annuities and, we're wanting to put too much in, we can quote this right along with the annuity quotes. All right, guys. Well, looks like the questions are done. Again, I want to thank you for spending time with me today. If anything pops up in the future, you guys know how to get a hold of us. Give me a call, and we'll get all your questions answered. So hopefully all of you have signed up and are coming to the Life and Annuity Expo on March 8th. I also want to put a plug in for April 5th. If you can get to Indianapolis and come to our office, we would love to walk you through some of the best income strategies you've ever seen. We're calling it our Annuity Income Symposium. Again, that is on April 5th, and we'd love to see every one of you guys out here. Income is the core of everything we do, guys. If we're selling life insurance, if we're selling Med Sup, if we're selling final expense, anything we want to sell, if you can become a master at showing people how they can increase their guaranteed income and show people how they can afford those types of policies that they need, long-term care, another one, mainly life insurance with long-term care benefits, understanding and knowing the best income strategies out there is what's going to make those sales possible. So don't want to miss that symposium. Again, it's April 5th. And I hope to see all you guys too at the Life and Annuity Expo on March 8th. So we're going to close the webinar out. Thanks again for spending time, and good luck, and have a great week, guys. We'll talk to you soon.